Good afternoon, everyone, and welcome to Beyond the Brackets, Apella Wealth's guide to navigating taxes for 2024, 2025, and beyond. This is part of our ongoing monthly Apella Academy webinar series, where each month a new topic filled with educational and empowering information will be shared. And right now it's tax season, and with tax season comes a lot of stress and confusion. And we're very excited for today's session because we hope to be able to translate some of that lingo and that language into something a little bit more digestible and understandable for all of you. Our panel of experts are here today, and our focus is to help you get a better understanding of the what, the why, the how of tax planning, to understand income, different ways that it's taxed, ways of reducing taxable income, understanding things like deductions, different types of accounts, strategies to help reduce taxes over the course of your lifetime. I do want to remind everyone that today's session is being recorded, and we hope that you find this so valuable that you'll want to share it with as many friends, family, and colleagues as possible. Additionally, I would call your attention to the Q&A box and use that throughout today's session to ask any question that you want. We will try to get to as many as possible. If we can't get to your question, we'll circle back to you after the webinar and try to answer those individually as well. So I want to take a quick minute here and introduce each of our panelists. And there's three folks from Apella joining us today. And I'm going to start with our first speaker, and that's Claire Thornton. And Claire splits time between our Arizona office and our Huntington Beach office. Claire is a certified financial planner, an enrolled agent, and has her master's in taxation. She was recently named to Investment News Top 40 Under 40, which is impressive. I aged out of that many, many years ago. And she's also a member of the Financial Planning Association, a frequent contributor to different periodicals in our industry, and has a great passion for helping women navigate financial complexities that are unique to them. So we welcome Claire. Next, we have Matt Gallagher, and Matt and I have worked together for about 7 years here. He's a certified financial planner here in our West Hartford, Connecticut office. Matt also runs the financial planning department for all of Apella. And our financial planning department oversees thousands of plans each year. So essentially, Matt's pretty much seen everything there is to see in the area of financial planning. And I consider myself incredibly fortunate to have him on my team. And last, but certainly not least, we have Ed Richter. And Ed brings over 40 years of tax experience to Apella. He's a CPA and a personal financial specialist. He works in our beautiful Lenox, Massachusetts office located in the Berkshires. Apella is incredibly fortunate to have someone like Ed on our team. He's not only a great advisor, but he's been a trusted expert and resource for all the advisors who work here at Apella. We, meaning the collective employees here at Apella, all the advisors, we try to work very collaboratively. And that's despite how geographically dispersed some of the offices are around the country. But at any time, if any of our advisors has a tax-related question or needs to bounce an idea or tax strategy off of someone, Ed's always our first call. So we welcome Claire, Matt, and Ed to today's session. So let's jump right in, and I'm going to turn this over to Claire to start today's session.
Great.
Welcome, Claire.
Thank you, Jason. We appreciate that, and it really has been a pleasure to take the brain trust of both Matt and Ed and pull together some really important high points for all of you today. So thank you for tuning in and hearing what we have. So the good news is, even though we are in 2025 and we're in the thick of tax filing season, there are still a few levers that you can pull to potentially reduce your 2024 tax bill. So I'm going to start with that. So just to kick it off here, this is kind of an easy thing to notate and keep in mind is you have until April 15th to fund an IRA or a Roth IRA or your health savings account. So let's take this from the top. With an individual retirement account or a Roth IRA, you do need earned income in order to make contributions. So you'll be limited by either the contribution maximum amount, which is $7,000 for 2024 and 2025, plus $1,000 if you're over age 50, you get that kind of catch-up contribution. So you're either limited to that or your earned income. So I always like to point that out to folks. And I know I mentioned a contribution limit, but I will refrain from doing that throughout the presentation to keep us from feeling a little dizzied by the numbers. So have no fear. The contribution limits for both 2024 and 2025 will be sent out with the recording of this webinar so that you have that one-pager, two-pager handy with you. Kind of diving into IRAs a little deeper, there is no gross income limit, so you can contribute up to the maximum of that IRA and not run afoul of sort of gross income limits the way you would with a Roth IRA. But I will caveat that with watching out for income limits if you or your spouse also have access to an employer-sponsored plan. So if you have access to an employer-sponsored plan, then your ability to make that deductible IRA contribution may be limited. So watch out kind of for that tripwire there. And the same is true if your spouse has access to an employer-sponsored plan, but you are the one making the IRA contribution, you could run up against some issues there as well. So the numbers are nuanced. They change from 2024 to 2025. So this is more of a call out to talk about further with either your tax preparer or your tax planner to make sure you're all set to make both of those sort of contributions if you choose. Nice feature too, related to retirement account contributions is if your spouse is the earner and you are a homemaker, maybe stay at home, kind of that side of the partnership, they can also make a contribution for you. So that's called a spousal contribution. So you can still continue to save for your retirement despite maybe not being the one who is the earner in the partnership. So that's a really nice feature of these accounts. I have a little asterisk next to Roth IRA because this will not reduce your tax bill today, but it could reduce your tax bill in the future, right? If we're kind of trying to do some arbitrage with some tax planning there. So I still add it to the slide, but please know if you contribute to that Roth IRA today, there's no tax deduction today, and Matt will get into a little bit more with the nuances of how contributions and distributions operate with the different retirement accounts. So I'll kind of leave that teaser there for all of you. On the health savings account side, really kind of neat feature to think about. To start, you do need to be on a high deductible health plan in order to fund a health savings account, but you do not need earned income. So really kind of your only restriction here is that you cannot be enrolled in Medicare. Once you're enrolled in Medicare, you lose the opportunity to make these contributions. But health savings accounts are really special in that they're what we call triple tax exempt. So to spell this out a little bit, you get a tax deduction when you make that contribution to your health savings account. Then you can invest those funds and any growth in that account when you then distribute the money for qualified healthcare expenses is not taxable. So you get that deduction on the front end, that tax-free growth, and then that tax-free distribution. So pretty special in that way and can really be an interesting tool for long-term growth. A few quick options that I'll also cover here for business owners. This filing deadline is a little different. It's your filing deadline plus extensions. So, you know, if you're a business owner, it gives you a little bit more flexibility in determining whether you'd like to make these sort of contributions and the deductions related to them. So if I'll kind of start at a high level and say, if you are a business owner, whether you're a solopreneur, maybe your spouse works with you, or you are an employer of others, right? So you're a business owner with several employees. There are some options here to really consider and think about. So on the solo side, really a solo 401k can be a really interesting feature to explore for a few reasons. One, you get a catch-up contribution when you turn age 50, the way that you would with any 401k plan. And then starting in 2025, there's an additional catch-up between ages 60 and 63. So you can really super fund your retirement in that respect. In comparison with the SEP IRA, you don't get those catch-up contributions. So I call out kind of that one teaser of a difference between those two, but under this bucket of options for business owners, there's so much nuance. There's so much opportunity for planning. So I place these out here on the slides as kind of opportunities to talk about further if you would like to talk with your financial planner here at Apella, or talk with your tax preparer about what it might mean to take advantage of those. All right, Jason, thank you. Okay, so I've taken a screenshot here of what the 1040 or our federal tax return looks like for 2024. The charming part about tax planning is that they just can't help themselves. They have to change the 1040 every single year, it seems. So, sometimes your eyes may take a minute to find, the bottom line of what you're looking for on your return. So have no fear, you're not alone in trying to adjust your eyes every single year. It's a brave new world every time. But what I am calling out here for you in particular is really honing in on the standard deduction or itemized deduction. So that's this section that I have kind of outlined in red. And the reason why I'm calling this out is we're going to shift gears a little bit from what sort of tax saving opportunities do I have for 2024 to what sort of tax deductions might I see on my return for this year. So what you might hear mentioned, kind of in articles, or maybe if you're at a cocktail party, is people talking about above the line or below the line deductions. So, when we're talking about this line, what is this line we're referencing? It's really line 11 on this tax return. So the line right above where it's standard deduction or itemized deduction. Those sort of deductions, examples of those are what we just covered in our prior slide. They're going to deduct your income as an above the line deduction. In contrast, what we're shifting gears to is below the line deductions. And we're going to kind of peel the onion on what this looks like as far as standard versus itemized deductions. So let's take a look at the standard deductions to start. Thank you, Jason. All right, so the standard deductions currently are really high. So that has really shifted really since 2018, the way that taxpayers think about standard versus itemized deductions. A lot less of us are taking itemized deductions because standard is so high and we're always going to want to take the higher of the standard deduction versus what we itemize. So standard deductions I have shown for both 2024 and 2025 to give you a picture of where we are. So, if we look, for example, at married filing jointly, you have almost 30,000 in standard deduction that you can take for 2024. So it's 29,200. And what this really means is you're going to take your gross income, your adjusted gross income, and then reduce it by the standard deduction. And then that's going to be your taxable income. So it's a really sort of powerful, I'll call it a gimme, right, from the government when it comes to, deductions that you can take. Without taking any further action, this is your starting point. A few things to note around standard deductions. One, if you are a widow or widower and your spouse died in 2024, you can still file married filing jointly in that year. If you're what's considered a qualified surviving spouse, so let's say you're a widow and you have dependents that live with you, maybe it's young kids, you can then file jointly for 2 years following your spouse's passing. So that gives you a ton of flexibility in really how you can think about your tax planning situation. Another thing to note is there are additional standard deduction options that you have if you are over 65 and or blind. So I've outlined those below. So if you think about if you and your spouse are over 65 and you're married filing jointly, boy, you really get quite a nice standard deduction to enjoy and offset for tax purposes. All right, thank you, Jason. So let's get into itemized deductions. This is where things get a little bit more nuanced, a little more quirky. So I think in some ways we probably thank the fact that since 2018, our itemized or our standard deduction has gone up so much because it keeps us from having to keep track of all of the little receipts and nuances that go into tracking itemized deductions. But if you are above those thresholds on standard deductions, then this is really your opportunity to buckle up and kind of peel the onion with me on what this means. So I have broken this up kind of in two columns. One shows our current structure and rules around itemized deductions, and that's on the left-hand side. On the right-hand side, you'll see this section called Post Tax Cuts and Jobs Act. I'm going to leave the right-hand side alone for now for a few reasons. One, Ed is going to get into a little bit later what this means, if there are provisions that do end up sunsetting, the impact to all of us on that respect, which would start in 2026. So for the sake of time, I want to leave that there. And also, we don't know whether this might change under the current administration. So really calling this out to say our current structure as it stands is really not permanent. You know, if no further action is taken, we will revert back starting in 2026 to this right-hand column. Few things to call out with itemized deductions, you know, with medical and dental expenses, you know, it's kind of hard to know where to start with this, right? What qualifies as a medical or a dental expense? And so what I like to provide to friends, family, and clients is IRS Publication 502. And I know that sounds very dry, maybe the sort of thing that would put you to sleep right before bed, but it's actually very user-friendly. It calls out some really helpful tips and I guess I should say examples of what you can take as a deduction. So that's a really big one that I like to call out. And you know, the rest of these items, for the sake of time, I'll probably not go too deep into, other than to say that if you're in a high income state right now, your income tax, your state income tax, and your real estate tax, you're capped at 10,000 worth that you can take as an itemized deduction. So, you know, since 2018, when this change happened, some of us in kind of these higher income tax states are grumbling a little bit more than the rest, maybe people in Texas or Florida would like to hear about. So, you know, please note that itemized deductions are nuanced. They're really kind of interesting. There is some opportunity to take advantage of here, but there's a ton of rules around it too. So please lean on us here at Apella and also your tax preparer to make sure you're squeezing the most out of your deductions. What I would like to do now, Jason, is really hand it over to Matt. Matt's going to get into some really great detail around the character around how different income sources are taxed and really all of the good stuff under the hood there.
Claire, before we turn it over to Matt, a question came in relating to one of your earlier slides. If this comes from CJ, and please continue to submit your questions here. If filing jointly and the husband's on Medicare and the wife is not, can the wife still put money into an HSA? And if so, how much?
Yep, so that's a great question. If she is on a high deductible plan, then she is able to still make that contribution amount. So, you know, and the nuance of kind of the maximum amount that you can make in that contribution is going to depend on when her husband went on Medicare. Yeah, hopefully that's
So the
helpful.
short answer is yes, and then we just need to do a little calculating.
Yeah, exactly right. Great
Perfect,
question.
thank you. Once again, please continue to submit your questions, even if they're more applicable to Claire. We'll get to those at the end. Take it away, Matthew.
Awesome. Hi, everyone. As Jason had mentioned earlier, my name is Matt Gallagher. I'm a financial advisor here in the West Hartford, Connecticut office, but I also manage our financial planning team for Apella. Today, I wanted to address some of the common knowledge gaps that we see as advisors as it relates to taxation of different income sources and retirement plan contribution types. Despite being taught that we should save for the future, few of us understand the taxation element of earning money, saving into a retirement plan, saving into a non-retirement plan, taking a pension or Social Security, or distributing funds from investment accounts. Education is a very important part of our mission here as advisors and planners. And after all, what good is a financial plan or tax plan if we don't understand it? The first main income type I'd like to, the first ordinary income type I'd like to review is ordinary income. So that's what most people think of when they think of income, right? And the subsequent taxes on that income. The most common sources of ordinary income would be your salary or W-2 income from your employer, your self-employment from your business, any rental income that you have from your rental property, pensions, whether they be federal, corporate, or municipal in origin, Social Security, which I'll get to separately since there's a bit more detail there. But those sources of income are all pretty easy to categorize as ordinary income for the sake that they have consistency typically in terms of payment, right? They come on a monthly or biweekly schedule. But there are other ordinary income sources that are just as common that we may not necessarily think of. That being dividends from your taxable bonds or foreign stocks called non-qualified dividends. It's important to note that if you have municipal bonds, those are not taxable at the federal level. And then also distributions from any pre-tax 401ks, traditional IRAs, all the distributions from there would be taxed at ordinary income rates. The taxation of Social Security is confusing for the sake that it's taxed at ordinary income rates, but the whole benefit isn't necessarily taxable. The taxation is graduated on a scale of 0% to 85% taxable, with the rates displayed here on the slide for single filers, then also for married filing jointly. It's based on something called combined income. So that's your adjusted gross income, or AGI. Then you add in non-taxable interest, and then half of the Social Security benefits for the household. So that's yours, and then your spouse's as well if you're married filing jointly. So it's possible if you are married and you just have Social Security, don't take any retirement account distributions, or you don't have any portfolio income, it's possible that most of your Social Security, if not all of it, could be free of tax. On the other hand, if you have pension income or portfolio income, that could push you up into the 85% threshold. The good news is, though, as soon as you reach the 85% threshold, there's no penalty for continuing to be in that space. 15% of the Social Security benefit will always be free of tax, no matter how much income is added on top of those thresholds. So, in short, it's taxed at ordinary income rates, but will be some combination of taxable and tax-free, at a minimum 15% tax-free. Then we have capital gains. And I'm sure most of us have heard the term, but probably aren't fully aware of the complete sources of capital gains and the tax impacts. The best part about capital gains is that they're taxed at preferential rates compared to ordinary income. And the best way to describe it would be the sale of a capital asset at a profit, right? So what does that mean in regular terms? That would be the sale of a stock, bond, mutual fund, or ETF in a taxable or non-retirement brokerage account. The sale of real estate at a profit is also a capital gain, but it's worth noting that for your personal residence, there's an exclusion of either $250,000 if you're single or $500,000 if you're married filing jointly. So chances are, if you sell your primary residence, there would be no or little capital gains owed with that exclusion amount. Then we have dividends from primarily U.S. stocks called qualified dividends that are taxed at capital gains rates. So if you have your U.S. equity mutual fund or ETF or stock, those dividends are taxed at the preferential rates. And remember from my earlier slide that not all dividends are taxed the same. The dividends from international stocks and then dividends from bonds as well are taxed at the ordinary income rates. So I realize it can get a bit confusing having the dividends taxed at different rates, but that's why I blame the IRS, our tax code, and our legislators for making it more confusing than it has to be. And then lastly here, Jason, you go back one slide.
Sure.
The sale of a business could be taxed at capital gains if structured properly. Then even within capital gains, it's important to know that not all capital gains are taxed at the preferential rates. So if you hold an investment for 1 year or less and sell at a profit, that's called short-term capital gains. And to make matters more confusing, short-term capital gains are taxed at ordinary income rates. If you hold an investment for greater than 1 year, though, that's long-term capital gains, and that's what's taxed at the preferential rates. If you sell an investment at a loss, those are either called short-term or long-term capital losses. And if losses exceed capital gains in a calendar year, you can use up to $3,000 of those losses to offset your ordinary income. And if you still have losses above taking that $3,000 income tax deduction, you can roll those losses into future calendar years, known as carry forward losses. And the great part about that is there's no limitation on how many years you can roll that into the future. You can accumulate losses and hold on to those for as many years as it takes to whittle that down, either through realizing capital gains or taking that $3,000 income tax deduction. On the subject of capital gains, losses, and dividends, it's important to remember that the portfolio income is only taxable to you in the current year and non-retirement investment accounts. If you have an IRA or 401k, all the portfolio income is deferred until you take the distribution, while in these non-retirement accounts, you'll have taxable income to you each year as you have dividends, interest, and capital gains or losses if sales were made. But now that we hopefully know the difference between ordinary income and capital gains, the next most important aspect an investor should understand is the savings options within retirement plans, that being pre-tax versus Roth contributions. So as Claire mentioned a bit, discussing her slides, pre-tax contributions are by far the most popular savings types into retirement plans, historically speaking. Contributions made to the plan reduce your ordinary income, which remember is taxed at the highest rates for that tax year. The overall concept being your income is highest during your working years, lower during your retirement years, so there's value in having that tax deduction today while you're working. The Roth contributions to retirement plans have been made more popular in recent years and even supported by the government in Secure Act 2.0 as they've expanded Roth contribution opportunities to different retirement plan types. Roth contributions, like Claire said, do not offer a tax deduction in the current year. Instead, the contribution is made with dollars that are counted as income in the current year, but the subsequent growth of those funds is tax-free upon qualified withdrawals. Both pre-tax and Roth contributions can be made to group retirement plans and then individual retirement accounts, also called IRAs. 401ks and 403bs are the most common group retirement plan types, where you can either save on a pre-tax basis, a Roth basis, or a combination of the two. Right? There's no reason why you'd have to stick just to one. You can do a combination of those two. This can be confusing that one group retirement plan, like your 401k or your 403b, can have both contribution types within the same account. But the good news is you don't have to have a separate account for each tax type. The 401k plan provider will keep track of how much is pre-tax versus how much is Roth in the statements that you should get every quarter. The individual retirement account space is a bit different than group retirement plans, and for a number of reasons, but one of them being by the tax type. Traditional or rollover IRAs contain pre-tax dollars only. They cannot house Roth contributions, and that's where you'd have a separate Roth IRA specifically hold those dollars that are tax-free. So we should look at an example of someone who makes $120,000 a year and contributes $20,000 total to their 401k. Contributions split equally between pre-tax and then Roth. So if they make $120,000, that $10,000 pre-tax contribution, that's a deduction that year. The Roth contribution is not. So the net W-2 income to that person would be $110,000. And had they saved entirely on a Roth basis, if the full $20,000 was made on a Roth basis, their W-2 income for the year would still be $120,000, since there's no income tax deduction for Roth contributions. The pre-tax contribution can be of great benefit, especially during your high income years. Jason, if you want to switch slides here.
Trying. There we go.
The IRS, though, I'm sure to everyone's surprise, is not an entirely generous agency. The IRS eventually wants the tax revenue on these pre-tax dollars through a provision called the Required Minimum Distribution, or RMD. But depending on your birthday, but either at your age 73 or 75, the IRS forces you to take withdrawals from pre-tax 401ks, 403bs, and traditional IRAs, whether you need the funds or not. And what you do with the funds is entirely up to you after you take the distribution and pay the taxes, but many folks encounter what they have to take from their retirement plans far exceeds the amount they actually need to take for their spending needs. The RMD is based on two main factors. that being the value 12/31 of the previous year, and then also your age. So you have your age, and there's a corresponding divisor published on the IRS tax tables. And what sometimes happens is that folks at either 73 or 75 may now be in the same, or if not a higher tax bracket than they were in retirement, than they were during their working years, for the sake that these RMDs can amount to these massive figures. This is what we call the ticking time bomb. People aggressively save on a pre-tax basis, save substantial retirement accounts, only to have these tax problems at 73 or 75, because any dollar pulled out of these 401ks and IRAs, that's all taxed at ordinary income rates. And even taxes aside, Medicare premiums are also based on income, so these RMDs can also drive up your Medicare premiums. The problem can be compounded when a spouse passes away, because you essentially have the same RMD amount, but you're now filing as single. And when you saved, it's potential that you were on a married filing joint basis. So the advantage to having some Roth dollars in this case is that the Roth dollars are not subject to required minimum distributions. It's only pre-tax funds. And even if there were RMDs on Roth dollars, which they're not, but there wouldn't be any taxes due on them since the distributions from Roth accounts are tax-free. But so now that you know the difference between pre-tax and Roth and the benefits of each, the next natural question is which is better for me and my family? And unfortunately, the answer isn't as riveting as a social media clip might tell you. The pre-tax argument, you save taxes today, potentially at higher rates, and you take advantage of the compounding deferred growth. The Roth argument is that you rip the Band-Aid off, pay taxes today when you know what the tax rates are, and then you enjoy tax-free growth. But the reality is that both tax types are important to a tax-diverse retirement plan. We often talk about investment and asset class diversification within your investment strategy, but not everyone considers diversification of tax type. If all of your investments are pre-tax, every dollar out of those plans are taxed at ordinary income rates. If all of your investments were only Roth and then free of tax, you might be missing out on those lower 10 or 12% brackets, where there's little tax owed, and chances are you would have paid taxes, let's say when you're in the 22% bracket. So if you have both retirement account types, you can be flexible as the tax code changes and how you take distributions or leave funds to beneficiaries. This flexibility is further enhanced if you also have non-retirement funds like I discussed previously, and those would be primarily taxed at capital gains rates. So ideally you'd have those three main account types there. And then to explain the difference in ordinary income and in capital gains as it relates to your portfolio and portfolio strategy, I'd like to turn it over to the person who I go to with my tax questions, and that's Ed Richter.
Hey, before I'm going to go rapid fire. Matt, 3 quick questions I think you can answer very fast here. Just came in on required minimum distributions. Is there an required minimum distribution on a Roth IRA?
There is no required minimum distribution on a Roth IRA.
Are RMDs still required for anybody at age 70, depending on your birth year, or does it start for 73 for everybody now?
It's 73. So if you're already taking RMDs before the legislation changed, you were still subject to that. But if there's going to be a subset of folks that fall under the 73 birthday, and then there's a second subset that's 75. Something I didn't get into, which we could discuss later, is that if you have an inherited IRA from a non-spouse, that would have its own separate required minimum distributions, which you could be 50 years old and have a required minimum distribution on that, which I didn't get to for the sake of trying not to overload everyone.
I'm going to guess here as to what Stephen might be asking. Is there an age you do not have a required minimum distribution? Meaning, I don't know, I made it to 100 years old. Does the government finally give me a break and doesn't make me take any more money out of them?
Nope. Yeah, they'll keep going until that account is depleted. So if you happen to need to deplete the account for the sake of your spending needs, and you take that account, the 401k or the IRA, down to zero, as long as there's no pre-tax funds, there's no RMD.
Right, you did it. You did it fast, Mr. Richter.
Yeah, I'll just mention too that there is a rule that allows the first year that you start taking your required distribution, you're allowed to delay the first year until the second year and take 2 distributions in that year. So there is some planning that could be done in that case.
Thank you, sir.
Thank you, Matt. Thank you, Jason. Claire and Matt did a great job explaining how we incorporate tax planning in our discussions with clients and the advice we provide them with. And Matt also discussed the differences in the categories of investment income, ordinary versus capital gain. My discussion today will drill into how we use the differences in ordinary or capital gain tax treatment to achieve tax savings. And I'm going to discuss a particular strategy that Apella uses called asset location. It's a strategy that aligns our clients' investments with tax efficiency to maximize after-tax returns. I know that's a mouthful, but I'm sure that within a few minutes, it'll all become clear. You've likely heard the old adage, it's not what you make, but it's what you keep. I'll be discussing and demonstrating how the asset location strategies that we use can improve net returns, or in other words, what you get to keep. On this first slide, it's really going into the very basics of taxation based on how much your taxable income is. I'll just take a couple of examples from this IRS chart. For instance, on the second line of the chart, once a joint couple hits about $24,000 of joint taxable income, or a single taxpayer hits about $12,000 of taxable income, they go into what's called the 12% ordinary tax bracket. And they will stay in that 12% federal tax bracket for the joint taxpayers from $24,000 to almost $97,000 of taxable income, and for single taxpayers from $12,000 to just over $48,000 of taxable income. So the capital gains tax rate for someone in the tax bracket of 12%, believe it or not, is 0%, a difference of 12%. So there's planning that can revolve around being in the 12% tax bracket and taking long-term capital gains, which are taxable at 0%. If we go all the way up to the very highest tax bracket levels, joint filers making over $750,000 and single taxpayers just over $600,000 are in that 37% ordinary tax bracket, capital gains tax bracket. The highest one is 20%. And there are some surtaxes which apply as well. They're the same in both tax brackets. But in general, you can see that in the lower 4 tax brackets, the difference between ordinary and capital gains tax rates are about 10% plus or minus. And in the higher tax brackets, the difference is around 17 to 20%. Large differences in taxation and understanding your taxation and how to get get that lower capital gains tax rate and get the savings is important. I'll mention on the bottom of the slide, these are important facts to know. Income taxes on ordinary investment income and taxable accounts are payable annually, not deferred like in retirement accounts. Income taxes on capital gain income and taxable accounts are payable only when realized or when the asset is sold. And capital gains tax rates also apply to that capital qualified dividend that Matt mentioned before. Those are dividends on US stocks primarily. And then finally, income taxes on retirement accounts are payable at ordinary tax rates when distributed, but no matter how they're earned, whether from stocks or fixed income investments. Next slide, please. You're likely familiar with an organization called Vanguard. We use Vanguard in many of our portfolios. Vanguard is one of the largest providers of mutual funds and exchange traded funds, ETFs, in the world. And over 2 decades ago, Vanguard's Investment Advisory Research Center published a white paper, a fairly lengthy paper detailing what they called their advisors alpha concept. And what the concept laid out is how financial advisors can generate substantial and more predictable value, which they called alpha, through various best practices, financial planning, evidence-based investing, tax optimization, behavioral coaching, and again, other services they described as best practices. I've included a link to Vanguard's most recent white paper published in 2025. And you'll get a copy of this link when you get our slide deck. But I'd encourage you to look at it and at least read the executive summary if you can. It describes what a financial advisor's best practices might be. I haven't laid them out on the slide, but again, they include establishing suitable asset allocation strategies with clients, investment selection strategies, rebalancing, behavioral coaching, and various tax-related best practices, including tax-efficient retirement strategies, tax loss harvesting, and finally the discussion I'll get to in a moment, asset location. Vanguard concluded that if all of these best practices are employed by a financial advisor, that the range of potential value or increased returns can even exceed 3% annually. That's a huge number. Let me give you an example, which is on the lower part of this slide, of the difference in rates of return, annual rates of return, that an asset location strategy can generate. So on the first line, we have a taxable account, and half of this particular clients' investments are in taxable accounts, half are in retirement accounts. We put all stock in the taxable account, and we put all bonds or fixed income investments in the retirement accounts. Well, the pre-tax return for that, or the hypothetical pre-tax return for that portfolio would be 5.2%, but on an after-tax basis would be 3.6%, using the highest rates of taxation on that table that we looked at before. In the next example, we put all of the fixed income investments in the taxable accounts, and we put all of the stock in the retirement accounts. Well, it's the same pre-tax return, but on an after-tax basis, the rate of return is 2.7%. And that's an additional value on an annual basis of almost 1% just by using this asset location strategy. And that's the strategy that Apella employs as a basis for investing our clients' investments. Next slide.
Hey, Ed, just a quick question relating to your previous slide. David wants to know at what rate is inherited IRAs from what are they taxed at? So if you had income from an inherited IRA, how would they be taxed?
So the income from an inherited IRA would be subject to either RMDs or discretionary distributions.
The
Under the
distribution
old,
itself, though, as they take the money out, ordinary
right, it
capital
would
gains.
be, well, it would be ordinary income. Yeah, distributions from retirements accounts are always ordinary.
Perfect. Thank you.
Thank you. So I just want to show you how we would invest a client's investments based on our asset location strategy. Well, first we would determine what is the overall asset allocation for the client's household. For instance, 50% stock and 50% fixed income. Then we would allocate stocks in the following order. First to Roth IRA accounts, best place for stocks to be because it's a forever tax-free account. Then we would allocate stocks to taxable accounts where they're eligible for capital gain tax treatment. And then finally, if there's additional stock which is over and above the amount to reach the stock strategy, we would put them in retirement accounts. We would then allocate the fixed income investments to the remaining accounts. We would lean towards placing stocks generating qualified dividends, those US stocks, domestic stocks, in taxable accounts, and lean towards placing stocks that generate non-qualified dividends, foreign stocks in Roth IRAs and retirement accounts, if need be. And that also results in most balanced asset allocation strategies with most, if not all, fixed income in retirement accounts. Next, thank you. Just to put some numbers on what I just said, in this example, someone has $1 million, 500,000 of that is taxable money, 400 in traditional IRA or retirement accounts, and 100 in a Roth IRA. And we've agreed on a 50% stock strategy or a 50-50 strategy. We would put $100,000 of stock in the Roth IRA. In this case, we chose to put $400,000 of stock in the taxable accounts, but leave $100,000 of fixed income for liquidity because this particular client needs some liquidity at this particular time. And then the remaining fixed income investments would go into the retirement account, achieving the asset location strategy that is ideal. And that's all I have on asset location, unless we have any questions on that at this time.
I think just it circles back to something Matt was saying earlier about the ticking time bomb, the growth of required minimum distributions. Having the fixed income not only reduces taxes today, but it helps to kind of tamp down the growth of those future required minimum distributions and essentially lower those in the future while focusing growth in more tax efficient places. Is that a pretty good summary of kind of an ancillary benefit of
Yeah, and just to say it a different way, you want your higher growth investments in your taxable accounts where they're eligible for capital gain tax rates, and you want your slower growth investments in your retirement accounts because they're always going to be treated as ordinary income, and you want to keep those required distributions to a minimum.
Fantastic. Keep firing those questions into the Q&A box.
I'm actually going to keep these last two slides pretty simple. I wanted to mention that there is tax legislation on the horizon. And as Claire mentioned, the provisions of the 2017 Tax Act are slated to expire by the end of this year. And the provisions that were enacted back starting in 2018 included lower tax rates, higher standard deductions, and increased estate tax exemptions. The current administration does not want those tax cuts to expire. And in addition, they are considering additional tax cuts, and they want to enact all of that by mid-year. The new tax cuts, there's a lot of things flying around. I'm not going to mention them today, and it's unknowable at this time, but it may become clear soon. So thank you for listening to me today, and I'll turn you back to Jason for any remaining questions.
So we have a couple of questions with some overlap in them, and I'm gonna kind of kick this maybe to you, Claire, first. We've got a question from Stephen about maybe a few instances where it makes sense to accelerate some income today as opposed to deferring it. And then subsequently, maybe part B to that, Bill asks a question about having all of his money in 401k. And is there a strategy to move some of that to after tax or just leave it as it is? And I think there's some connection between those two questions.
Yeah, absolutely. Thanks, Jason, and great question. So, to start, I appreciate the question around when does it make sense to accelerate income? Because I think our brains are kind of trained to think, how can I defer tax as long as possible? How can I make my tax bill today as low as possible? But you really have to have, this long horizon in the way you're thinking and being strategic. To Matt's point, there is a potential tax bomb, right? If we're not thoughtful with when we accelerate income, when we reduce our income. So, a few sort of high-level scenarios to consider when you're thinking about, is this a good year for me to bring in more income? And that can look like a lot of different things, whether you're, kind of controlling the amount of ordinary income that's flowing into your picture for the year through earned work. Or if you're doing Roth conversions, right, taking money out of an IRA and choosing to then put that in a Roth IRA for future growth. Hopefully I said that right. Take it from an IRA, put it in that Roth IRA.
Yeah, you got it.
Okay, thank you. So, let me think this through here. If you are maybe in your last year of filing joint as a widow or widower, you may want to take full advantage of that married filing joint tax bracket, because once you move to single, your tax rate is effectively cut in half, right? So meaning your income is going to reach higher tax rates much quicker. So if you're trying to get ahead of what that could look like with your various moving parts in your new income picture when you're single, it might make sense to accelerate some income while you're still in that joint bracket. If you're having a year in work where your earned income is much lower than usual, well, that could also be an opportunity to take advantage of things like Roth conversions. So those are kind of two big ones that come to mind for me, but really taking a 10,000-foot view, because every situation really is so nuanced. Am I in a year where my income tax is unusually low? Or do I expect that my income tax rate could be higher in the future? Okay, let's start having that conversation about what levers we should be pulling to, take advantage of those, what I call cheap tax brackets today. So that's kind of an abstract answer, but hopefully those two sort of concepts kind of stick out to you. If that speaks to you, we can talk through that further, right? Or you can talk with your Apella advisor about that further. And then kind of to dovetail around Bill's question, which is really apt one that I think Matt, Ed, and I kind of get excited about, is kind of this future planning. So you're 62, you're retiring soon. What should I be doing? What sort of opportunities should I take advantage of when it comes to a 401k where I have kind of a large tax deferred asset to work with? That could be a real opportunity. Looking at all of your other income sources to see, should we be taking money out of that IRA sooner rather than later, either in the form of just a flat out distribution into a non-retirement account or into that Roth conversion for that Roth and future tax-free growth. That's really going to depend on your goals and your needs, how you structure that. But it sounds like, Bill, there could be a greater conversation had there around how you can kind of best leverage accelerating some income now, not waiting for those RMDs.
Yeah, I think to that point, Claire, there's just great opportunity set between RMD age and retirement age, where all of a sudden income is much, much lower, and that's a big opportunity set. And Bill is rapidly approaching that with retirement on the horizon here. Matt, maybe
Jason?
Yeah, sure.
Jason, I'll just mention quickly, probably most of our listeners know that Apella has sophisticated financial planning tools that can help identify those years where there may be opportunities to accelerate income or bring in income at those lower tax rates. Fairly recently, we've begun using a specific tax planning tool, and it allows us to analyze clients' tax situations and prepare forward-looking projections to identify those same opportunities. And they look at it on both a federal and a state level. Probably many of our clients or listeners aren't aware of that recent capability that we have, but
No, I think it's an important note. Like there's a lot of tax preparers out there who don't help a lot with tax strategy. There's some great CPA partners that we all have and who do an amazing amount of work. But for those just general tax preparers, maybe that you're not getting some strategies on how to reduce current and future income taxes. We do have, to Ed's point, extremely sophisticated tools that do some incredible projections, and they're actually fun and they're interactive. So if you do decide to reach out on those, don't feel like you're going to fall asleep in one of our conference rooms. They're actually pretty exciting as far as tax tools go. Matt, maybe I'll throw this one to you. A question from Tyler about how are annuities taxed?
Yeah, my favorite subject, annuities. Annuities, I guess kind of at a bird's eye view, there's kind of two main forms of annuities. That would be ones that are accumulating, where you've put money in and it's in growth mode, whether it be variable or on a guaranteed basis. And then there's the form of an annuity in terms of taking a monthly payment. So in the instance where you have an annuity that's in accumulation mode, if it's funded with an IRA, any distributions out of there would be taxed at ordinary income rates. But if you fund it with after-tax dollars, so if you put $100,000 into an annuity and it grows over time to $150,000 and you'd like to start taking distributions, if you take partial distributions, you actually have to take the gains out first, and the gains are all ordinary income since they were deferred for all that time. So the annuity defers all the income until you take distributions. You have to pull from the gains first at ordinary income rates, then eventually you'll get into your basis, and that would be free of tax. But if you had the $150,000 annuity and then annuitized it, meaning you asked the insurance company to give you an income stream for the rest of your life or for a period of time, that would be some combination of return of principal. So some of it would be tax-free, and then the investment gain would be represented as ordinary income in that payment. So it would be a combination of taxable and tax-free. But if any annuity funded by an IRA, any distributions out of there would be taxable at ordinary income rates. Hopefully that was clear enough. I know annuities are their own universe.
Yeah, it's a foreign language inside of a foreign language. I think we've got maybe 1 minute, 2 minutes tops here, so I'll let you go around the horn on this one, where Peter asks, it's pretty early in the year. Can you share a few tax-related tips how a taxpayer can set up their year for success? And Claire, I'll kick it to you first. We'll just go in presentation order.
Yeah, sure. So it's a great time of year really to kind of take inventory on this front because we're starting to file our returns. So I think, one nugget I'll share so it's not take all the good stuff from Matt and Ed is if you file your tax return for 2024 and see you have a huge refund, and maybe that's the pattern you've had over many years, that's a real opportunity to adjust your withholding to make sure you're keeping more money in your pocket throughout the year. So really look out for that. If you're receiving a refund, I think over $1,000, there's a real opportunity to do some good work there.
Matt, anything you'd like to bolt on to that answer?
I would say review all of your automatic contributions. It's pretty easy to be asleep at the wheel with your 401k contributions or HSA contributions or any IRA contributions. If you're still working and you have automatically 5 or 10% withdrawn from your paycheck to go into your 401k, if you haven't reached that maximum contribution yet, it's great for year over year to increase your contribution by 1 or 2% to slowly work up to that full contribution. I know making that full contribution can be tough, and it's difficult to do it kind of all at once from contributing a little bit to contributing a lot. So year over year, increasing the withholding percentage for the 401ks or HSAs, even making those contributions, slowly increase it over time so you can kind of work that savings muscle and not try to bite off more than you can chew all at once.
Ed, any final thoughts on how to set up 2025 for success?
Yeah, I would encourage all of our clients who are listening to get their tax returns to us as soon as they're finalized so that we could understand what their tax situation was last year. Did all of the planning that we did last year actually come to fruition, and set up the current year the right way? There might be modifications we need to make to your tax plan for this year, or how your investments are located, for instance, based on your current tax situation. Sometimes with new clients, we get the question, why do you need that? Well, it's really important.
It's probably the most valuable thing we get from anybody as we're in the financial planning process. Would you agree with that, Ed?
Yeah.
All right. So we have come to the end of this presentation today. Our hope is that everybody learned at least one thing that can help make their plan a little bit more tax efficient. And hopefully we've encouraged you to reach out to us with any additional questions for some tax planning strategies. There's a lot that we can help you with. So if we didn't get to your question today, we will do our best to follow up with you. But please reach out to your financial advisor. And if you don't currently work with anyone here at Apella, please reach out on our website, the Contact Us button, and we'll put you in contact with somebody in your area who can help answer all of your financial planning questions. The last thing I'd like to add is that, once again, we've met with Apollo last month to recap 2024. Today's session, incredibly valuable on what's going on in the world of tax. At the end of this month, on March 25th at 4 o'clock Eastern, we'll be doing another webinar on Social Security. And I know that all of us here on today's panel, I'm sure, are getting lots of questions about Social Security. Will it be there for me? How do I claim benefits? Changes in taxation and rules around Social Security. So please, I encourage you to sign up for that. The invitation will be sent out, I think, later this week. There'll be more webinars. Go to our website for additional ones coming up in the future. We greatly appreciate all of you sticking with us for this past hour. We hope it was beneficial. Look for the recording, those additional materials that Claire and Ed promised you when we send out the recording. and share it with all of your friends and family. And we look forward to seeing you again later this month. Thanks, Ed. Thanks, Matt. And thank you, Claire. We'll talk to you all soon.